Hello everyone, this is Paris. Welcome to Budgetholics. In today's video, we're going to go over the life-crushing enemy of our personal finance, which is debt. We'll go over why you should focus on paying off debt, the types of debt you can have, and the strategies you can utilize to eliminate it. Whether that's student loan debt, credit card debt, or even a mortgage, you know what I'm talking about. And if you're one of the few who have no debt, then you're among the lucky ones. However, stick around as these strategies may prove useful in the future. Keep in mind, I'm not a financial advisor, and you should never base your financial planning on just the advice of some random guy on the internet. This video is about strategies I have found useful, and it constitutes just my thoughts and opinions. If you're interested in personal finance, investing, and wealth building, and if you want to learn how to budget your money properly and build a sustainable future, please hit the like and subscribe buttons as this helps me immensely with the YouTube algorithm. Without further ado, let's jump into the video. Your debt affects your entire financial life. How much you owe, how consistently and timely your payments are, and to which degree you can afford the debt you have, based on your income and assets, radically affects your ability to take on new debt and the interest you are charged. Moreover, just the simple thought of knowing that you can pay off your debt will help you sleep at night. The first reason that should motivate you to pay off your debt is your credit score. Every entity has a credit score, including individuals, companies, and even countries. In the case of countries, it's called a credit rating. And you may have noticed in the news that when a country's credit rating goes up or down, everybody is going frantic. If you are a US citizen, you must have heard of your credit score. Your credit score measures how risky you are as a borrower, therefore it measures your credit worthiness, meaning how much financial institutions can trust you. Your credit score is calculated based on your past behavior with loans, credit cards, and other financial products. And some countries, such as the US, have hundreds of different credit scores, and each financial institution is using their own. But other countries, even if they don't call it that, also have credit scoring systems. So this is not limited to US residents. And each credit scoring system has different criteria. For example, in the US, they do not consider your income when it comes to calculating your credit score, whereas in most European countries they do. If you want more information, check out this Business Insider article, for which I'll leave a link down in the description. Apart from your credit rating, having a huge debt over your head affects you psychologically. A CNBC report found that student loans take a very large toll on millennials. And we all know somebody from our generation who struggles to pay off their student loans. As we also know people from previous generations who are struggling to pay off either credit card loans or even mortgages. With college fees increasing and salaries increasing at a lower rate, an even larger percentage of our salaries is going towards debt repayment, and that prevents us from either spending our money in the real economy or investing it for the future. And until a government comes and erases that debt, we need to figure a way to pay it off ourselves. To do so, we need to first identify the enemy. And debt is divided in two categories. The first is installment debt, and the second is revolving debt. Installment debt is the easier to fight, the easier to plan about, and usually it has the lowest interest rate. It describes a type of financing where you borrow money a single time from a lender, and then you're expected to pay fixed amounts during fixed time intervals. Examples are mortgages or student loans. You get borrowed the money once, and then you know what you have to pay and what interest you're being charged. The second and most difficult category to track is revolving debt, which allows you to borrow funds time and time again up to an approved maximum amount. And this max amount is your credit limit, which is set by your lender. In this case, the trap is that you'll decide how much you borrow and how much you pay each month, aside from minimum payment requirements. Examples of revolving debt are credit cards and cash advances. And these types of debt usually have the highest interest rate. There are two ways people classify debt: in terms of their size, i.e. how much money you own in that specific debt, or in terms of interest rate. When you go into debt, whether that's a credit card or a mortgage, you get charged an interest rate. And you can think of the interest rate as the price a bank, a credit card company, or any other financial institution is charging you to lend you money. Mortgages and student loans usually have low interest rates of around up to 3%, whereas credit card companies charge you around 20%. One of the reasons is the risk involved. When you get a mortgage, you put this money in a house in which you live or you rent, thus making it less likely for you to default on that debt without actually losing the home. But in the case of credit cards, there is no guarantee you'll pay off your new iPhone or your daily Starbucks dose. Plus, those things are likely to lose value in the future. There are two main strategies people follow to go debt-free. The first is the snowball method preached by Dave Ramsey. Using this strategy, you start paying off your smallest debt first. The reasoning behind this is that you gain a certain amount of satisfaction and achievement when you start clearing debt off your balance sheet. As you knock off your smaller debts one by one, you'll feel that you're making concrete financial progress towards your goals and towards becoming debt-free. Plus, you'll also free up some extra cash to put towards your larger debts. The problem with this strategy is that although it takes into account the psychological factor of achieving small goals, which then motivate you to keep going, you end up paying higher interest rates, leading to paying more interest in the long run. That's why the other strategy, called the avalanche method, focuses on paying first the highest interest rate debt. When it comes to pure logic, it makes sense to start paying off the higher interest rate debts first, because this debt is costing you the most money. If you pay the high interest rate debts first, you'll free up more cash in the long run, which you can then put towards paying smaller interest rate debts. However, when your high interest rate debt is extremely high, and this also happens in the case of mortgages that have been refinanced time and time again, you may spend more than a year paying it off. Then you might feel that you're not making enough progress towards becoming debt-free, and it can be difficult to stay focused and stick to your goal if you don't feel like you're making any significant progress. For this reason, you need to seriously take into account what type of person you are. Are you someone who relies on pure and cold logic? Or are you someone that needs some small incentives to keep going? And both strategies are fine. The snowball method will cost you more, but it has a higher chance of succeeding, whereas the avalanche method will cost you less, but it's more likely that you'll quit. Reflect on those two strategies and consider which one fits you best. Finally, you should consider how much you should allocate towards debt repayment. And at this point, I want to give a shout out to another random guy on YouTube, Jasprit Singh, and his channel Minority Mindset. What I'm going to say in this part of the video, I found it in his channel, for which I'll leave a link down in the description. When it comes to budget allocation, there are two main categories you can fall in. The first category is you being a single young professional with few financial responsibilities. If you fall in that category, you should spend up to 50% of your income, invest the other 30%, and use the remaining 20% for debt repayment and savings. As I've said before, it's good to keep up to 6 months of expenses in a high interest rate savings fund and treat it as an emergency fund. If you don't have a savings account, you can sign up to Revolut using the link below. Revolut is a digital bank that offers you up to 4.25% interest rate on your deposits. And if you want a savings account for your crypto, you can use BlockFi. BlockFi is a savings account for cryptocurrencies paying up to 8.6% interest plus up to $250 on your first crypto deposit. You can also sign up to BlockFi using the link below, and you can put half of the 20% towards that. The other 10%, you should put it towards paying off debt. Once you have saved up enough money for the 6 months of expenses, put the entire 20% towards paying off any debt you have. Paying off debt is the only guaranteed return you can have on your money. You're not losing to inflation, and you're gaining the 20% you would otherwise pay to your credit card company. Another bonus is that if you're young and you've paid off all your debt, firstly, that helps you sleep easier at night, and secondly, that radically increases your credit score, meaning that when you want to buy a home for yourself, you can negotiate a lower interest rate. The second category you may fall into is you having a family or other financial responsibilities. In which case, as Jasprit says, you should spend the maximum of 75% of your income, invest 15%, and the other 10% save it until you have 6 months of expenses, and then pay off debt. In the case of you having financial responsibilities, it's important to first set up an emergency fund for the needs of yourself and those that depend on you. Afterwards, you should put the other 10% you have towards debt repayment. Keep in mind that these two budgeting options are just models, and models are used to simplify reality and give us a simpler, better understanding of the world. If you don't need to spend 50% of your income and you can put more money towards investing, saving, and debt repayment, do that. You'll reach your financial goals faster rather than later. Also, do not fall into the trap of ignoring your debt, simply investing, or even worse, spending your money. As you set up a debt repayment plan, you need to figure out which strategy works best for you, the snowball or the avalanche, and what percentage of your income you can allocate towards paying your debt and stick to it. And do not commit to a strategy you know you won't be able to follow in the future. Just like you shouldn't commit to a very restrictive diet, which at some point you're going to abandon and drive to McDonald's. When it comes to personal finance, consistency is key. If you know you have several small debts that you can knock off, you can go ahead and do it. And then you can determine whether you want to keep paying the smaller debts or focus on high interest rate debts. If you have credit cards with similar interest rates, you may want to pay off the smaller balance first and then move on to the larger ones. Keep in mind that some debt, such as student loan debt, has some tax benefits, in which case talk to your accountant or another financial planner and ask them if it makes sense to postpone paying any of the debt you have. But all in all, consider all your options and choose the plan that will save you the most while also making sure that this is a plan that you'll stick to. If you enjoyed this video, please hit the like and subscribe buttons, as this helps me immensely with the YouTube algorithm. If you have high debt or if you've managed to pay off all your debts, please let me know down in the comments below. And if you think somebody will benefit from this video, please share it. You can also get in touch with me in social media, Facebook, Twitter, Instagram, whatever you prefer. I'll leave a link for those down in the description as well. Until we meet again, pay off your debt and don't stop investing. Cheers.